Well, hi, everybody. Welcome back for another exciting iteration of our markets and economy update. We're here tail end of summer 2025, so excited to be with you all today. Just as a refresh, or if this is your first time tuning into this, I'm Jarrod Musick. I'm the CEO here at Destiny Capital, and I sit on the investment committee along with Tim. So my role is to really be a thought partner and think about how do we link up our investment strategies and decisions with individual client families, and how are we going to implement some of those pieces. Tim?
Yeah, thanks, Jarrod. My name is Tim Doyle. I am the Chief Investment Officer here at Destiny Capital. I handle all things investments. That includes capital market research, manager selection, fund due diligence, portfolio construction, asset class selection, trading, rebalancing, and more. And each month we do this webinar, and I construct a client letter that we send out each month just to communicate what we're seeing across the market and across the economy. And we've got some interesting information that we can share this month. Just some hot off the presses news that I think is meaningful and should be informative for our investors. So excited to get into it.
Awesome. As always, we have to hit our disclosures here. So we've made every effort to make sure that the information that we're sharing with you is accurate. Please use it for informational purposes only, because it's possible that we made errors. We've done our best to make sure that we didn't, but it is possible. To that, if you already work with us, fantastic. Thank you so much. Reach out to your client service team if there's anything that you want to discuss from a planning or investment perspective, and discuss how that would work and be best for you and your family. If you don't work with us, talk to your wealth advisor, CPA, tax advisor, somebody who knows what they're doing before you make any life-altering decisions. We're not going to discuss specific securities in this webinar. If they happen to come up in conversation, we may or may not maintain positions in those individually. We're not trying to talk our own book or talk about our own investments here, but we may end up having that conversation for some reason. And then we are a registered investment advisor, which means we're governed by the SEC and all those good things. So with all of that goodness out of the way, definitely top of mind and top of news right now with jobs reports, where the labor market is at, and quite frankly, how we measure that and look at that data and project it going forward. So if you've paid attention at all in the last few weeks as of this recording, you've seen something about like the head of labor statistics for the US and how we're getting that data. So Tim, do you want to kind of walk us through what we've seen in terms of data, what's been happening with revisions, and our thoughts in this area?
Yeah. It was a Friday. It was Friday, August 1st. I was expecting kind of a slow day to close out the week. And then we got the July jobs report that just, blew that out of the water. Headlines started to emerge across the financial news media. Markets started to react. So I opened up the BLS jobs report to see what was going on. And I saw that, 73,000 jobs were added in the month of July. That was versus 110,000 estimated, so far below estimates. But that happens, right? That's fairly common. There are misses as it relates to these jobs reports. That's fairly common, like I said. So what was the story? Why were markets reacting so harshly to what we were seeing here? And it wasn't so much because of the July jobs numbers, but because of revisions that came in for the two prior months, so May and June, and the jobs numbers that were reported then. So to illustrate this, I put together this chart to the right that shows in blue, all the blue bars represent the initial jobs numbers reported for each month. So the months of April, May, and June, and July. And then the red bars represent the revised numbers, so the revisions. So I want to be clear that when the BLS releases a jobs report, the first report, the one we got for July that was released on August 1st, is called the first estimate. We will get two subsequent revisions to that number over the next 2 months. So every BLS jobs report is subjected to two eventual revisions. So what we got in this July report were the revisions essentially for May and June. And those revisions were quite extraordinary, as you can see. So if you look at the month of May, originally the BLS reported that we added 144,000 jobs to the economy. That's great. That's a solid month. That's a fairly good number, signifying strength of the labor market. That has since been revised downward to 19,000. That's a very, very different number. Fast forward to the June number. In June, we had 147,000 jobs initially added, or at least initially reported. That number was downwardly revised to 14,000. So those are big differences. So suddenly, in the blink of an eye, investors had to digest the fact that 258,000 fewer jobs were added in the months of May and June. So what had been a source of strength for the U.S. economy, the labor market, suddenly looks like maybe a weak link in the chain. Is this something we need to be concerned about? Is this something the investors or the Fed really need to be paying attention to moving forward as it relates to interest rate policy, for example, which we'll get into a little bit later? In this case, like Jarrod said, the commissioner for the BLS was fired by President Trump. His interpretation was that these revisions were politically motivated. We don't really believe that's the case. Like I said, these are always revised. We see this as a situation where they're working with incomplete data versus manipulated data. So the BLS, each month, they survey 119,000 different businesses and governmental organizations to take in this labor market data. Essentially, they're looking at headcount. And if the headcounts go down for a corporation, that means the BLS is assuming jobs were lost. But like I said, they have a kind of a loose deadline of the 12th of each month to collect that data. And anything else that shows up after that 12th of the month will be included in the next revision, right? So I think what likely happened in this scenario is some big hitting data came in after that 12th of the month deadline, and therefore got pushed to the revisions. And those revisions, really affected the numbers more so than we've seen in quite some time. So it's alarming. It's difficult as investors. We can only make the best decisions we can with the information that's available to us today. So these numbers are frustrating. In May and June, we were thinking, okay, the labor market's in pretty good shape. Now, all of a sudden here in August, we're saying, oh, okay, is this a cause for concern? And how does that change our mental calculus moving forward and how we see the markets, how we see what's going to be going on in interest rates? And we'll talk a little bit about some of that moving forward. But Jarrod, anything else you wanted to add to that? I know that was a big change for investors to absorb. But one I wanted to note and talk through as we met today.
Yeah, I think really two takeaways for me this month about this topic. The first is there's probably some methodological changes that have been needed at BLS for a while when they're capturing this data. So I think there's an opportunity for them to reevaluate with this new leadership. Hey, how do we better connect directly with data from payroll providers? How can we get cleaner source data earlier on in the process? So just sort of using outdated practices, I think, seems to be the takeaway that I've seen most often. But then the second one is, yeah, it's concerning when you're seeing very anemic job growth for 2 consecutive months, and then even the initial numbers coming back for July don't look great. So I think that's something that we're very cognizant of from an investment standpoint, that most of our economy is centered around consumption. If the consumer is not working, not getting higher wages, if they're feeling at risk in their job, they're going to spend less, and we're going to see that directly show up in economic activity. So I'd say it's, perhaps an early warning sign for us, something that we want to be very mindful of.
Yeah, not something we want to overreact to. The unemployment rate's still at 4.2%. That's still very close to a full employment. So not signaling alarm bells right now, but something we definitely want to keep an eye on.
Yeah, And as we kind of move into another big input, and this is going to go into, a little bit of our discussion about the interest rate environment and the Fed, because they have this dual mandate. And number one is full employment, which is never really fully defined. It just means we want the economy to be working well and lots of people to have jobs, right? The second one is inflation. So we want stability of prices over time. Notionally, their target is a 2% inflation rate over an extended time period. What are we seeing today, Tim, in terms of changes to underlying inflation?
Yeah, it's been interesting. We just got recently our latest CPI report, so Consumer Price Index report, that showed in July that core inflation, and we really pay attention to core inflation. That's what the Fed is paying attention to. They pay attention to both core CPI, but more importantly, core PCE. We don't have the PCE numbers just yet, so we're going to focus on CPI. And in July, core CPI ticks up from 2.8% to 3.1%. So clearly moving in the wrong direction. That's not really what we want to be seeing. But 1 month does not make a trend. I want to be clear about that. It's alarming. It's heading in the wrong direction. We just want to try to gauge whether or not that trend is going to continue in the future. And that's really what we're trying to dig into. And we'll talk a little bit about that on this slide as well. Then we got producer prices. So PPI, the producer price index. That's essentially what producers are paying at the wholesale level. And it was expected that PPI would come in at 2.5% in July. It actually came in a bit hot at 3.3%. So why do we pay attention to PPI? Well, if producers are paying more for goods and to build goods and so forth and produce goods, you would assume that they would eventually pass that added cost onto consumers. So it's kind of a leading indicator we would consider for what's going to be coming down the line for inflation. So then, so looking at that, that's concerning. That's something we want to be paying attention to, both those CPI and PPI numbers. But then I found it really interesting. I was reading a report produced by Goldman Sachs, and their findings were really fascinating to me because it spoke to an element of what's going on in the economy that I was very, very curious about, and that's essentially the impact of tariffs on prices. Who's paying for them? Are they being passed on to the consumer? Are they pushing inflation higher? Will they push inflation higher? And that's exactly what this report and this chart to the right essentially speaks towards. So if you look at the chart to the right and the pie graph on the left side, what you're seeing is the dynamics of who is paying for the added cost of tariffs right now. So according to Goldman Sachs, they're finding that U.S. businesses are currently covering 64% of the cost of tariffs. Then you look at foreign exporters, and foreign exporters are covering 14% of that added cost, and then the rest is being passed on to consumers. So consumers are covering 22% of that added cost. Is that always going to be the case? According to Goldman Sachs, no. That dynamic is going to change, and it's going to change significantly and quickly. So if you look at the pie graph on the right side of that page, you see a fundamental change there on who's paying for what. So they predict by October of 2025, U.S. consumers will be paying 67% of that added cost. So roughly 2/3 of the cost of tariffs will be borne by U.S. consumers. Foreign exporters will be paying 25%. And then we see U.S. businesses kind of receding into the background there and covering only 8% of the added cost of tariffs. I thought that was going to be, I'm actually surprised to see that they are initially covering 64%. I've said over and over again in my writing and in our commentary here that U.S. corporations don't like to see, lower profits, and higher tariff costs would reduce profits. And it hasn't, apparently it's not going to take them very long to step out of the limelight there and pass the added cost onto the consumers. So what does that mean for inflation? Well, that means that according to Goldman Sachs, they believe that core PCE, and like I said on the previous slide, core PCE is the Fed's preferred measure of inflation. They expect that by end of year will rise to 3.1%. Keep in mind, the Fed's target for core PCE is 2%. So that's 1.1% above target and moving in the wrong direction. as it stands right now. And then if you look at CPI, and CPI is what's most commonly referred to by the investing public. We see CPI, all over news headlines and so forth, more so than PCE. And CPI over the last 2 years has trended roughly 50 basis points higher than PCE. So if we see PCE at 3.1%, we could expect to see CPI at closer to 3.7%, so almost reaching that 4% number. So if that turns out to be the case, you can rest assured that consumers are going to notice, investors are going to notice, voters are going to notice that trend, and that's just going to be something that, I want to stress, this is one report from one financial institution in Goldman Sachs. Again, you don't want to overreact to predictions and projections because they can be wrong. But I found it interesting, particularly around the dynamics of who's paying for what right now as it relates to tariffs and who is expected to pay and cover that cost moving forward. And it's always been clear in my mind that it was eventually going to be the consumer, but it looks like Goldman Sachs believes that estimation as well. Jarrod, anything else you wanted to add to some of that commentary?
Yeah, I think when we're looking at those numbers around inflation expectations, it's easy to look at it and go, oh, 3.1 is pretty close to 2. Who really cares? That's not the way that the Fed looks at it. They go, inflation is running 50% higher than what we want to see it at. That's a problem, right? Because that trickles into a lot of other things in the economy. And their chief concern is inflation going to get away from us? Are we going to get in this place where all of a sudden it jumps to 5, 6, 7, 8%, kind of like where we were back in 2022,
Yeah.
and now they really have a big problem. That's when
Yep.
I think consumers, voters, taxpayers really, really get upset is if you're seeing these large price jumps in everything that we need to spend our money on a day-to-day basis. So I definitely, sorry, our slide skipped forward on me. I definitely think that that is a concern, and we're going to get into interest rate policy here in a couple slides. So I think inflation looks like it's going to remain persistently higher than what the Fed has said they want it at. The second piece around tariffs, Tim and I have been talking about, hey, our tariffs, knowing that we as the US federal government need to raise more revenue to close the budget hole that we're in, are they viewed as the most frictionless method of raising more revenue? Because if it's a property tax, well, you get a property tax invoice, you
Right.
know how much you're paying. If it's an income tax, you see it on your pay stub, you know how much you're paying. And if it's a sales tax or a value added tax, which is fairly common in a lot of other developed markets, like Tim has talked about, particularly in Europe, well, you're still seeing that on your receipt at the time of purchase, right? It's very visible. A tariff just shows up in, well, 3 years ago, I used to pay $100 for this item, and now I pay $120 for it. Like, I know it's more expensive, but I don't really know whose fault that is. Is the company price gouging me? Is the steel that goes into this thing more expensive? Is it taxes? What's going on here? It's really difficult to associate on a one-to-one basis and say, yep, this is tariff cost. So I think tariffs are likely to remain. And it's very clear that we're going to see that increasingly being passed through to the end consumer, which, as you said, Tim, is what we always anticipated. I'm quite frankly shocked that US businesses have been buffering that cost a little
Yeah.
bit and probably dripping it in to say, hey, consumers are going to handle this a lot better if the price of this good that they buy every month goes up 5% a month for 4 months rather than 20% all in 1 month. So I would imagine there's probably some careful calculation going on their end about how do they best pass this through, but we're probably getting there quickly. So
Yeah.
agreed on all counts.
It's like when you go to a restaurant and you have a party of 12 and the gratuity is automatically added onto that bill. So you just sign the bill because you know that 20% gratuity is already included. But if it's a smaller table of 4, you have to write out the tip and so forth, and you're manually doing that. And I think it probably feels a little bit differently. This is the way for the government to slide in, added costs and impact, their loss of revenues and hopefully, bridge that budget gap. But yeah, it's a fascinating time. And if anything, like you said, many of these trade deals are becoming a little bit more cemented. So it looks like, yep, they're not going anywhere. This isn't a ploy to get a better trade deal, or more favorable terms with our trade partners. It looks like these tariffs are here to stay. And with a 16.3% effective tariff rate on average across all trade partners, that's a pretty hefty tariff number, and that could, bring some real revenue to the U.S. government. That's for sure.
Yep. So, I think this is sort of our bringing all of these things together, right? Interest rates tend to have an outsized influence on near-term investment returns. What are we seeing in terms of Fed policy and projections around interest rates going forward?
Yeah. So in this presentation today, we've talked about two elements of the Fed's mandate. They have a dual mandate. They have a mandate of stable prices, and they have a stated inflation target of 2%, and they have a mandate of full employment. And that's loosely defined as the unemployment rate at roughly 4%. We're at 4.2% right now. That's pretty close. That's pretty good. I would consider that very, very close to full employment. But right now, we're seeing these two different mandates heading in different directions. So we could be seeing the unemployment rate moving higher if these jobs numbers persist and we see cracking in the labor market. We could just see weakening in the labor market, and that's something we haven't seen in years since the pandemic, really. The labor market's been incredibly resilient despite really restrictive monetary policy from the Fed. It's really been amazing. But are we finally starting to see those cracks emerge? And is that something that the Fed needs to pay attention to moving forward? And then, as we said, we expect inflation, the cost of tariffs to be passed on to consumers a bit more. We expect prices to tick up a little bit higher. So inflation is going higher, and the unemployment rate is potentially going higher. And what the markets are doing, so what the markets have done, essentially since we got that August 1st jobs report, is price in additional rate cuts. So what the market is thinking is, well, we're seeing cracks in the labor market. The Fed is going to want to address that. How do you address that? You lower interest rates. Lower interest rates help to boost the economy, stimulate growth, which in turn they would hope would boost hiring, right? And fill in those cracks in the labor market. So right now, the market is betting on at least one 25 basis point rate cut emerging from the September 17th Fed meeting. And then if you look on the right, you'll see the target rate probabilities. These are the market estimations for where the Fed funds rate will be by year end. And we see markets projecting at least a 50 basis point rate cut or 75 basis point rate cut between now and year end. So long story short, markets are betting that interest rates are going down. What if that doesn't happen? What if we start to see these inflation numbers come in hot month after month, and the Fed really needs to pay attention to that? Which mandate are they going to prioritize? Because to combat inflation and keep inflation in check or even push it down, the Fed would have to potentially either keep rates higher for longer or even maybe move them higher. They certainly wouldn't cut rates by 50 basis points or 75 basis points if inflation is a concern. So the Fed has a dilemma. And fortunately, we are getting in quite a bit more data. We'll have another jobs report. We'll have another PCE report between now and the time the Fed meets in September. So I think they're desperately hoping for some better jobs numbers when we see the August numbers as it relates to both jobs and inflation. But that remains to be seen. And so what does that mean for investors? That means there's uncertainty. There's a lot of uncertainty as it relates to both the job market and inflation, and in turn, interest rate policy. So what happens when there's a change in trajectory and these 50 basis points or 75 basis points and rate cuts don't emerge? Well, investors can expect to see market volatility. We could give back some of the gains that we've seen over the last few weeks as markets had started to price in lower interest rates in recent weeks. So that's really just something to be mindful of. That's That's not out of the ordinary. This is not something new for us as investors. This happens all the time. It's just something to be mindful of. We've had a good year as it relates to performance, asset class returns, and we'll get into that on the next slide. But we've had quite a ride up since the beginning of April. Really, markets have rebounded close to 30% since then, and you just can't lose sight of the fact that we're in a time of elevated uncertainty, and uncertainty can lead to some volatility coming down the line. So, Jarrod, anything else you wanted to add to that?
Yeah, I think you hit all the high points, Tim, but it always creates additional downside risk when investors at large are projecting interest rate cuts in the near term, and the data for us is kind of pointing to don't plan on it.
Yeah.
We don't think we're going to get rate cuts here this year, and we're behaving accordingly.
Yeah, and I think it's important to note, it's our belief at Destiny Capital that the Fed is likely, if they have to prioritize one versus the other, the Fed is likely to prioritize inflation, combating inflation versus boosting the labor market. We've just come through an extraordinarily difficult time of elevated inflation, something we hadn't seen in 40 years, and it's incredibly painful for consumers, for investors, for just about everyone. That's not something they want to see. I think what we're going to hear a lot about in the coming weeks is that, well, this is just a one-time blip in inflation due to the added cost of tariffs. This will eventually, dwindle away over time, and we'll see inflation go back down to normal, the normal 2% over time. Well, we heard that the last time we saw inflation start to tick up in 2021. The Fed started using the term, well, this inflation is just transitory. Does everybody remember that? Well, transitory, it was not. So I don't think the Fed wants to make that same mistake twice. I think they're going to be very, very patient in combating inflation and not letting that get out of hand once again. Because once that horse is out of the barn, it's really hard to bring back in. So I think, in my personal opinion, they will prioritize, at least in the short term, inflation. And if we start to see cracks in the labor market become a chasm, and we really see the unemployment rate rise to 5%, 5.5%, then maybe that calculus changes. But I think the Fed's focus really still needs to be on combating inflation, even if that means keeping rates higher for longer. So that's just kind of our take at this point.
Yeah. Well, as we wrap up, we've been, I wouldn't say negative. We've been talking about risks, which is what we tend to do from an investment perspective.
Yeah.
You're always balancing risk and opportunity. The year's been pretty good for investment returns overall. Do you want to kind of wrap this up, just walking us through what's happening and what's contributed to the good performance?
Yeah. When I play sports with my son, if we're shooting baskets or hitting the baseball or throwing the baseball, I always say end on a high note, right? So if you make your last basket should be a made basket. It should be something positive for you to think back on as you're practicing. So I think we'll end this webinar on a high note by talking about Q2 earnings season and asset class returns. So, when you think about returns we've seen, especially since April of this year, they've been very, very, very strong. And even on a year-to-date basis, returns have been very strong. We've seen the S&P 500 approaching 10% return. The Dow Jones Industrial Average is about 6.5. NASDAQ is close to 11. Even small caps are getting into the act. Small caps are up almost 3% on a year-to-date basis, and bonds are up 4.5%. So that's, in any given year, that's a very, very good year. Something I think most investors would take in a heartbeat. And U.S. corporations are certainly doing their part to help in that scenario. We are about 90% into. So we have about 90% of S&P 500 companies reporting corporate earnings thus far. So we're at the very tail end of corporate earnings. So we have some data that we expect will hold, and the data is very, very encouraging. It's very strong. Earnings season was very strong, even relative to near historical averages. So when it comes to earnings, we've seen 81% of S&P 500 companies have reported earnings above estimates. So that's an earnings beat on 81% of S&P 500 companies have reported an earnings beat. They've also had 81% of S&P 500 companies reported revenues above estimates, so beating on both the top and bottom lines. Those are great numbers. Both of those numbers are well above the 5 and 10-year averages for earnings and revenue beats. So good news there. We're also seeing really, really strong year-over-year earnings growth. So we've seen the earnings growth rate at just around 12%. Coming into earnings season, I think most analysts were expecting earnings growth to be closer to 4 to 5%. So hovering in close to 12% is really a really strong number. And that, if this number holds, and I expect it will, I don't expect this to dip below 10 for sure. This would represent the third consecutive quarter of double-digit earnings growth. So 3 consecutive quarters of really strong earnings, which would really help to support what we're seeing in financial markets. It means that fundamentally the stock market is doing well. Valuations are getting elevated, and that's something we're always keeping an eye on. But earnings and U.S. corporations are certainly doing their part to help investors. And we all we can really hope is that the Fed and everything that's going on in the labor market and inflation and so forth doesn't gum up the works so much that it starts to impact what we're seeing, because U.S. corporations are actually doing quite well. And that's both the Mag 7 and that's the Magnificent Seven companies, as we always talk about, but also the remaining companies in the S&P 500 have done their part as well. So, anything else you wanted to touch on before we close out, Jarrod?
No, I think that's a good positive note to end on. We talk about the risks and the future state and what we're concerned about and monitoring. At the core, the U.S. economy and the global economy is in pretty good shape right now.
Yeah.
So hopefully we're able to see some of these risks moderate themselves over time and we continue going forward. So great way to wind it up. I think, Tim, I'll let you close us out for the day, but for me, thank you everyone for some of your valuable time. Please, if you have questions, things you want us to go deeper on, ideas for future topics, head over to destinycapital.com. There's a CIO mailbag where you can include things, or if you're a client of ours, just send it to your client service team. We're happy to dive deep on any topics of interest. So, Tim?
Yep. Yeah. I also want to, before we close out, just wanted to remind folks that I do a CIO mailbag. So if you ever have any questions, forward that to either me or your client service team members, your strategist or your coordinator, and they can pass those questions on to me, and I'll be sure to address those in future posts to make sure we're getting all of your questions answered, because for sure there was a lot going on out there in the market economy today. So, but we appreciate your time as always, and thank you for joining us.
Yeah. Thanks, everyone. Have a great one.